Hi everyone. This month we've got Ed Burbidge, and he's the CEO of I&M Burbidge Capital. We're honored to have him as usual, and so thank you for joining us, Ed.
Pleasure. Thank you for having me.
So we're going to start off with getting to know you and getting to know a bit about you, although I know that you're very well known in the market, so no worries from that end. But you studied accounting. How did you know you wanted to be in financial services? Why accounting, etc.?
Yeah, okay. So actually, I did economics as one of my A-levels, but then I went to uni. I focused more on politics and French, believe it or not.
All right.
And then I
Parlez-vous français?
Oui, je parle français.
Très
oui.
bien.
Oui.
Hey, I like your accent as well.
Yeah, I tried. That's probably the hardest bit, actually. But I kind of got bored of that and got just sort of floated into doing some accounting and tax modules.
Okay. Mm-hmm.
And I found it so much more interested. I loved the sort of binary nature of it, you know, that you're either right or you're wrong.
Yeah.
Unlike politics. And so that really got me realizing that I was much more interested in that. And then my first job was working in the city as a fund manager. And I did my CFA, which I actually love miles more than any other academics I've done before.
Part,
it's a lot of accounting, financial statement analysis, and investment valuation, securities analysis.
Oh wow! All right,
yeah.
So very deep mathematical and statistical
financial
analysis,
maths, exactly.
How did you get into your first job? What was it like being in the city? I don't know what years we're talking. Are we talking early 2000s?
I'm pretty old. So early 2000s, basically. 2002, I think it was. I got my first job.
Where was it?
For one of the reasonably big UK stockbrokers called Tilney.
Okay.
Which then got bought by Deutsche Bank, Deutsche Private Wealth. Mm-hmm. So I worked on a fund of hedge funds.
Okay.
And then I was a senior analyst on a credit fund, basically buying European government bonds and highly rated corporate bonds.
And what was it like being in the city at that time? Have you ever watched Industry?
Yes,
Industry.
I love it.
What do you think?
Yeah, but it's really hard to get here.
It's BBC iPlayer, I think.
Yeah, can you get that here? I didn't know that you could.
Well,
it's been very useful for me already. Maybe not quite so much for your listeners. Yeah, no, I like that, and I love Suits. I bet you watched that.
Suits, yeah. Was it like that? Was it like similar, cutthroat?
Well, no, I mean, it's quite cutthroat. So I started in fund management, right, which I didn't really enjoy. I found it quite boring, to be perfectly honest. Mm-hmm. It's on the buy side, certainly in the part that I was in anyway, it's basically a lot of people looking over each other's shoulders and trying to see what the competition are doing. You have to slightly outperform the competition on your performance every month. So it was away from the fundamentals and more looking at what everyone else was doing, which I didn't really like. And then I always loved selling. And so I moved into investment banking after that. It took me a while, but that was what I really wanted to do and what I always loved. Mm-hmm. And so I worked in investment banking in London for a decade, and it didn't feel that cutthroat to me. I mean, I wasn't a trader. You know, we had the investment banking division, and then we had the trading division, the research, and the brokers. Yeah. And the traders, it must have been very high pressure for them. I mean, sometimes they lost a lot of money. Sometimes they lost so much money it undid all of the revenue that we'd earned in the other divisions in the bank.
Mm-hmm. Was that still for Deutsche Bank then?
No. That was Arbuthnot Securities.
All right.
Was the last investment banking firm I worked for in the UK. Sort of mid cap. Advisory business. Yeah.
And when you say investment bank, from that side of the business, what was it looking at? Deal structuring? Was it looking at the target businesses and how to what the best structure to invest in, or what was the actual meat and bones of the work then?
Yeah, basically exactly what we do now at I&M Burbidge Capital. So structuring. And raising capital or selling businesses, basically. Yeah.
And how did you end up in Kenya then?
Yeah, good question. So I'd worked in the city for long enough. You know, I felt like I had enough qualifications and experience to do it on my own. I mean, I was happily part of a really successful team at Arbuthnot, with some really, really capable people, and I learned so much. And we were closing another deal every 2 weeks. It was unbelievable, actually.
Were the deals in Europe or they were European based?
Yeah, well, basically international companies listing on the London Stock Exchange.
Okay.
And so quite a few of them were African. And so that gave me a sort of a taste of my interest in Africa, I suppose. But anyway, so I felt like I had enough experience and a strong enough CV to come out here and give it a go. And so
why here though, out of everywhere that you could have gone?
I think I was just most interested in Africa, you know. I always loved investment banking, always. Like from day one, I almost couldn't believe that somebody would pay me to do that. Maybe I hope my employer's not listening.
You're not employed anymore, are you?
Well, kind of, actually. But, you know, I always absolutely loved investment banking, corporate finance, but I was really bored of being in London, in the city, and everybody looks the same, everyone does the same job. I found it really tedious. But I love the investment banking itself. So I wanted to move to somewhere much more interesting, and it's definitely much more interesting here. Also higher risk and, you know, all that sort of stuff, but it's rarely boring.
And so when you came to Kenya, you set up Burbidge Capital immediately?
More or less. I mean, before I even resigned, actually, I flew out for 2 weeks and did a recce, picked up a client that wanted to raise money.
Really? Already? In 2 weeks?
Yeah, who I felt that I could help. I mean, in the nicest possible way, I think one of the attractions and one of the sort of ongoing advantages here have been the competition is not quite so well developed, shall we say? Yeah. It's quite varied here.
But it's getting there now. More and more, I think.
I don't feel it that much, actually, for various reasons. You know, there's always sort of things happening, and for quite a lot of detailed reasons. It's nothing like it was in London, where, you know, you could walk into any of 50 investment banks and get the same kind of quality, probably, of advice.
Well, that's true. Maybe that's true.
And capital raising abilities, basically.
So you came here for 2 weeks, you did a recce, you found a client already. And then
sorry.
Came back
thanks for getting me back on track. Yeah.
And then you established Burbidge Capital.
So then I found a client that I was happy with, and so I flew back and resigned. And flew out, you know, and then I was single then, I wasn't married, I didn't have kids, and so I could do that kind of thing. Did you not know anyone in Kenya? One person. I had one contact.
Oh, wow.
Yeah, it was a good one.
I mean, that's really brave.
And it's foolish, you know, in hindsight, it was absurdly foolish, really. But I didn't have the responsibilities then that I have now, and so I could do it. So I did. I've always been sort of somewhat impulsive and followed my instinct on things. And that was definitely an example of that. But so I flew out here straight away, started working, and actually I'd intended to go on to Zambia. You know, where there's a lot of agriculture and resource financing to be done. And mining, I guess. Exactly. Yeah, it's quite a lot of the stuff I did in London was mining, natural resources, mining, energy, etc. So that was why Zambia appealed to me. And then I was going to go on to South Africa after that. But I never got to either. I never left Kenya. There was just so much opportunity, evidently, here. And it's such a lovely place to be as well.
Was it very easy for you to set up and get clients very easy? Was it plain sailing? Were there choppy waters? What was like kind of the hardest type of experiences you had when you first set up?
I think I was very young and very overconfident. And so I thought it was going to be a piece of cake. I sort of thought I'd be the chap who came in from London and everyone would give me their deals
Once you're from London, it's golden, right?
That's what I thought. But it wasn't like that at all, actually. People here, I still think this is the case, and it's an advantage now, is people want a tangible track record here. They want to know you and to be able to kind of touch your business and have friends you've worked with. Recommendations. They don't trust, you know, anybody, and I can understand why that is. You know, given the number of sort of not so competent people may have put themselves out there here and all that sort of thing. So actually, it was way harder than I expected. And took me a lot longer to get established in the market here.
And what was it like you're selling? What was your pitch to people? What was your proposition? Is it something that they already understood and just needed to refine? Or is it something that you needed to explain to them the basis of how you could help them in their businesses?
I mean, I think initially I focused a lot on equity capital. And public capital markets, right? I mean, I came from London where there were there's a very, very vibrant small and mid-cap capital raising avenue through the public capital markets.
Yeah.
And I'd seen that being really successful, and I thought, part of what I would bring would be helping to develop the public capital markets here, getting more IPOs, that kind of thing.
Yeah.
And I spent a lot of time and a lot of money on that to begin with, and it got pretty tight because I had to spend so much on it and hire really expensive people. And it took me 4 or 5 years for the penny to drop that's unfortunately not really where the action is.
Why doesn't it work in this country?
Here. Oh, how long have you got?
About 10 minutes.
So, I mean, there's so many reasons, but in order to cut to the chase and try and give you an answer, I think above all it's cultural, actually.
Yeah.
I just don't think that company owners really want to be in the limelight here. They don't want to be on the front pages of the newspaper, having everyone know how much they earn, and how much profit or not profit they made last year. It's not like that here. Whereas I think in the UK, where I came from originally, that's everybody's dream. They all want to be on the front pages of the FT, right? And have everyone sort of seeing how great their business is and that kind of thing. It's the opposite here. Ultimately, I think that's the problem. It doesn't matter how many, how easy you make it, how cheap you make it, how hard the regulators try, and they do try really hard. There are lots of people trying really hard to make it work here. But ultimately, it doesn't really matter because of that cultural issue, I think.
And is that something that's going to change, or you've just given up on that segment?
No, we haven't given up on it. I mean, we still, do public capital markets deals as and when they come along, but we tend to do them in conjunction with other brokerage firms, investment banking firms and that kind of thing. And for them, they have it as part of their daily business because they're trading every day, they're writing research and that kind of thing. So we tend to team up and do it via collaboration when we do those kind of deals. The majority of what we do these days is private capital markets, right? Private equity, DFI investments, banks, local and international banks, credit funds, mezzanine funds, etc. And let's start with Burbidge Capital. How did you find target companies, or how did you pitch yourself to the market so that they would come to you and you could help them then raise? What was your angle? Yeah, so basically once I'd realised that they weren't all just going to come flooding through my door because I was fresh in from London, it was in a way the hardest route. What I had to do was take on deals that others hadn't really been able to close and get them closed. They were the only ones that people were prepared, to give me a shot with.
If you could do the hardest work, then I guess, you're worth the price, right?
Well, it's just, the easy deals, the way it kind of works, I think, in our industry is the easier deals go to the more established players, right? And so it's a barrier to entry once you get there, if you manage to build your business up to that level. But to begin with, you've got to scrap for the stuff that the bigger firms don't want. And so that was the harder deals, and somehow I managed to get some of those closed.
I'm not going to comment on the difficulties in getting deals in this market. Sure. So then you decided to team up with I&M. What was that decision? Why that decision? Why I&M particularly?
Yeah, so that was a big step for us as Burbidge Capital. I mean, I think one of my other misconceptions was, in London or Europe or New York, quite often I think if companies want to raise capital, they'll go straight to the city, or straight to Wall Street, to the investment banks. Whereas here, what I was finding was companies are more likely to start at the bank, actually. At the traditional commercial bank. And so, it made sense for us to be part of a banking group for that reason.
And have direct access to that clientele.
Exactly, for origination purposes, as well as to their existing clients. So, funny enough, it wasn't I&M who first gave me the idea. It was another bank who subsequently have gone under, actually.
Oh, no. So
it's a good thing I didn't team up with them.
Yeah,
but the CEO of that bank walked into my office and said, look, we should consider a collaboration for this reason. And the penny kind of dropped for me. But I thought, if I'm doing this, I want to look at all the banks and I want to choose the best one that's out there. And I&M was certainly the best of the banks that didn't yet have advisory investment banking in a big way. And we had cross, board members and really good sort of links into each other. So it was relatively straightforward. We both considered it a really good concept from both perspectives.
So what is it that you'd learned from, helping other target businesses get equity investment that you then used for your own investment when it came to I&M?
Yeah, good question. I actually look at it the other way around, that I think it gives me a nice perspective to be able to give to my clients. When they're selling their business or they're bringing on an institutional investor, that not only have I done it for lots of businesses here, but I've also done it myself. It's different, when you're looking at the warranties and indemnities, definitely, and it's your own risk. It's all very different. The valuation, etc. It's a lot more emotional when it's yours. So I sort of look at it from that perspective. But your question was the other way around. I mean, I think I like to think I'd learned a bit of patience, but not much. But a little bit. It takes a long time
whenever
to close
we've been on a transaction together, when we have been together, you've certainly been the most calm in the room.
I thought you were going to say the most impatient.
No, I thought the most calm. I think you know which deal I'm talking about. Let's talk about the normal 9 to 5 now. What does it look like? I know your day starts around 5 a.m.
5:30.
Finishes around 7 p.m. with a glass of wine. What does your day look like? What does your job entail for anyone who is thinking about going into corporate finance, that kind of advisory work? Anyone who wants your job, Ed.
I'll just tell them what they need to do. Well, I think time-wise, like you say, I normally get up at 5:30. I didn't really used to do that, but I find the Nairobi market quite early, an early morning sort of thing. A lot of stuff starts early here, so it's quite nice to feel ahead of everybody or ahead of the curve. If you get up early, then that's the case by the time you're in the office. I mean, I then work out every morning, drop my boy to school, and then go to the office. But I'm still there by 7:45.
I mean, that's quite early.
Which is still earlier than most people, I think. It just gives me time, I usually, when I'm in the gym, actually, I'm usually just kind of doing my emails from overnight and mapping out my day, planning everything, making sure that I'm prepared for all of the meetings. So then when you get there, it's more like a pleasure, really, because you're well prepared for it.
Planning is key. Planning is
absolutely key. Absolutely. And then I normally have too many meetings, really, 8 or 9 a day, probably. It's it's rare to have an open spot in the diary, probably like yours, I suspect. But these days I'm more overseeing teams, my senior teams who are executing the deals anyway. So quite a lot of the stuff I'm either sort of listening in on, or I've done my inputs before the meeting.
What's the best part of being the CEO?
I guess, it's what I used to think was the worst part, the HR. That is difficult. I used to loathe it. Now I love it. Now it's kind of what I come to work for, actually. And origination. Origination's always been my favorite. It probably still is, actually, and dealing with the clients. It's the relationship side of it, really. I think that's probably always the case for investment bankers and corporate lawyers as well. You've got to enjoy interacting with your clients.
Because there is a lot of interaction, so you do need to enjoy spending time with people.
But it's quite easy, I think, because they're all such interesting people, right? They're all people who are at the top of their game, running interesting businesses. Quite often they've built them up themselves from scratch, particularly here as well. They're always really interesting people.
Definitely, I think from an origination perspective, it's the people who have gotten to the top of their game, having built something that is amazing to me. And being a startup myself, or in a startup position, I understand now what it's like to run your own business. It's tough. It's really tough.
But you can really relate to the people.
Yeah, correct. Have you ever rejected a potential, target? Have you said, no, I can't work with this person? And if so, why? Yeah,
I mean, probably not as many as I would have liked to, particularly when I was building things up. It's hard.
Well, you can't say no, can you?
It's harder to say no. I mean, I think now we're part of a listed banking group. I'm obliged.
The
AML KYC is intense. And rightly so. I mean, I don't have any issue with that. I feel like we're aligned on that, really. We're all trying to make sure we deal with people who we'd want to deal with. I think, but like we were saying, you know, and maybe it helps that I have this perspective of having been through it myself with my own business, that they really relate to me. And so I very rarely find myself in a shouting match or in a tough conversation.
I can't see you shouting, Ed.
Yeah, it doesn't happen that much anyway, but thankfully I don't get shouted at too much these days as well.
If you were advising a potential target company about how to be investor ready, or what attracts potential investors into their business, whether it be a small private equity fund or, you know, DFI at the larger end, what would you give them as the number one piece of advice to become investor ready in their business?
I think it comes back to planning again, you know, like you were saying, it probably is, you know, one of, if not the most important thing for running a business, but also for preparing your business for that, you know. I think what quite often happens is that investors are interested, and then, you know, they meet the business and it's evidently the records are not in good shape.
The records, I always say the records, just your books, are they in order? I think is something that, you know, can really differentiate two businesses from another. And then the due diligence is easier.
Yeah, and you don't get caught out along the way. You know, we've seen deals fall over quite often in countries outside of Kenya, actually. A lot of the Kenyan businesses are pretty well organized. I mean, it just depends. You know, a lot of the work we take on these days is for mid and large cap firms. So obviously they have a pretty good finance function, CFO, legal documents are in okay order and that sort of thing. But so, yeah, I mean, I think the preparation is really important. I think the reality of it is, as well as it's hard to raise capital here, you know, and so until recently anyway, the business needed to be quite well developed. You know, to be perfectly honest, if you want to raise money from banks, from DFIs, from PE firms, you can't. Generally, you need a track record, you know, profitability, history, etc., except for certain sectors. You need to be a reasonably well-established business. So it's really more in that case about being aligned with an investor. You know, I think you have to be quite open-minded and have a good temperament. You know, I don't think you can't think that you're just going to dictate to investors. You have to understand that if they're going to come and be invested in your business, they're taking a big risk
as well
on you and your business too, and they have underlying investors who they're responsible to. And so I think you need to be open-minded about the fact that you probably need to give them a board seat. You know, that there'll be board committees that come in, there'll be reporting, shareholder reporting that needs to happen. Maybe you'll need to step up your audit firm, those sorts of things, and you need to be somewhat realistic on valuation. I think a lot of people, I see this less these days. I think actually the Kenyan market is much better developed and more realistic on valuation. But 10 years ago when I was setting up, you know, somebody would have had their cousin who'd done a few months of accounting, right? Tell them, oh, your business is probably worth like 30 times EBITDA or something. And then once they got that number in their head, people get quite fixated. And it's really hard to pull them away from that. But if you go out to the market with a deal and you have unrealistic expectations, it's going to be disastrous for everybody. Everybody will lose their reputation and you'll be back to square one. You lose lots of money, basically. So it's kind of about maturity of approach, if I can put it that way.
I mean, that's very good advice, I think. Let's talk about valuations and, you know, looking into the Kenyan market itself. Are you still seeing deals being done is Kenya the main hub for East Africa, deal making wise? Are people looking at Rwanda more? DRC is coming up as well. And also let's talk about valuations, because people do still complain about high valuations and unrealistic expectations. Are you not seeing that anymore? Are you seeing that people are becoming more realistic?
Quite a lot of questions there in one go. I'll have to. It's going to be a good test for my brain to see how I get on with that. Are you awake, Ed? Yeah, exactly.
Let's talk about valuations first, because you touched on that.
Okay, fine. We'll do it in reverse order. No, I find generally it's a lot more realistic actually these days. I mean, there's two things going on at the moment. You know, I was saying before that it was really well-established companies with track record who can raise capital more easily. But now you've got the VC.
That's a huge
thing really
part,
taking off in East Africa, and that's totally different.
Yes,
actually.
Completely different. Yeah,
and there's valuations that reminded me of that, because valuations there are very different, and it's in a way it's not helpful actually, because it's taken 10 years to get people's expectations reasonable for, if let's call it mid-cap deals, mid and large cap deals. Now, in the old days, we'd be sitting in a room and we're on the sell side, so we're representing clients, and we'll put together a process, we'll build an IM, the model, and we'll introduce them to, let's say, 6 or 7 of the most likely investors. Yeah. And then it's kind of a case of, put your best offer forward. Yeah. And that's how we get the best value for clients. And in the old days, we were sitting there and watching them put these really high, too high offers, much higher than fair value forward. But we'd done our job for our clients, so that was sort of that. But now, I think everyone came under a lot of pressure from their underlying investors not to overpay. Yeah. And so now I rarely see that happen. I think most institutional investors will dig in their heels at or around fair value. Yeah, yeah. And everyone is kind of okay with that. Yeah. We try to advise our clients what fair value is as well. Yeah. So it sort of gets done. Then VC has come in and absolutely blown things away.
And the parameters are completely different. They're not even...
Yeah, exactly. That's exactly right. They're only looking for, for something like 1 in 10 to work. Correct. I'm not an expert on that sector. We're sort of starting to do more and more in it. But I'm no means an expert in it yet. But as I understand it, that's about right. I still don't think that should feed through to valuation, logically. But anyway, it seems like that's quite a major debate.
They're looking at different things, because they're saying, is this business the idea? Is it solvent? And so can I take the risk on whether or not in 5 years' time I'll make triple of what I invested in?
Exactly.
And it's not going to be on a valuation. There's nothing to value against. So it's going to be on intuition. And
I think that's true. And I mean, if it works, you're going to make like 1,000 times money or something. And so to a certain extent, it's immaterial. Yeah. I still slightly upsets my financial principles but I get it. And I also buy into the argument that if a business is going to double in size next year, it's worth a lot more than if you value it on standard metrics for a business that's going to grow 10%. Okay. So, more or less. But also, they've taken a big correction in the last 3 or 4 months. Yeah. And so interestingly, the VC investors that I talk to and some of the companies that are trying to take VC money are suddenly quite conscious. They're quite nervous of the fact that they might actually be asked to be nearly making a profit, right? Or that the multiple isn't going to be as totally astronomical as they thought it was. And that's fine. So that's the market feeling its way around towards a sort of equilibrium, perhaps. Yeah.
Let's talk about then the region. Is Kenya still going to be, where the deals are made? Are we looking at more at Rwanda, DRC, Uganda, Tanzania, etc.?
Yeah, so we actually put out a publication every month on deals.
I don't get it.
Oh, really? No. Sorry.
I also don't get invited to your events, but anyway.
Need to speak to the marketing team. So we track basically the corporate deals in East Africa. Okay. We've done it for about 7 years. You must have got it at your old place,
maybe at my old place, yeah. So maybe we should get it. We should put a link for everyone here.
Oh, yeah, sure. Please do, yeah. So we track the corporate deals. So actually, I have a reasonably informed answer to your question. I mean, it's one of the reasons we do it is so that we're well plugged into what's happening. Yeah. It helps to shape our strategy, but it's also a good marketing tool for us. But anyway, basically what happens is at the moment, about 80% of the deals are in Kenya.
Oh, wow. Quite a lot. That's a lot.
Yeah. And maybe 12% in Uganda. Wow. And the rest are really a trickle for Rwanda, Tanzania, Ethiopia. Yeah. I think that's sort of changed. Don't forget it's proportional, right? That's a percentage. So as the number of deals increases, that means that more deals are still happening in those other countries. Yeah. But it's about scale, really. I mean, Kenya has that. The Kenyan economy has that scale. Yeah. And quite often, I suppose, they're actually regional deals, right? Somebody's buying into a Kenyan business, but they're getting exposure through their regional subsidiaries to the region. I think, well, you and I were at the conference in TZ,
correct,
the VCA conference a couple of weeks ago, and it was exactly what I was hoping.
Yeah.
You know, it was full of a lot of the senior representatives of DFIs, PE firms, etc., which kind of mirrors what we're seeing in the market, which is a lot of people want to get invested into TZ now, and that's a big economy relatively as well. So I'd expect to see a big pickup. It might not happen that quickly, but over the next couple of years, I'd expect TZ to take up a bigger proportion of that.
I mean, that's a good thing for us as well.
Why?
Because of the fact that first of all, we're in the region.
Oh, so as in all of us here. All of us. I thought you meant you and your firm, actually.
Not just me, no.
Yeah.
Yeah,
for sure it is. For sure it is, yeah. Yeah.
Okay. All right. Well, I guess the other question is then, in terms of the deals, then, are we looking at particular industries, or are we just looking at, the traditional... I think fintech is taking up a huge chunk of that, isn't it?
If you have a fintech deal, people will buy into it. You can be almost quite sure if it's a well-established business.
And is it any fintech, or is it agri-tech? Do you know that are there those statistics as well?
So let me tackle your question from the top. Sector-wise, if you leave aside VC for a moment, I'll come back to it. But traditional financing sources, so banks, DFIs, private equity firms, mezzanine credit. They're pretty open, really. There aren't that many sector specialist funds. Where they are sector specialists, it's probably in financial services and healthcare. And
I think
agri,
that people have played around loosely with the word impact, so that anything could be potentially impact.
Yeah, but to a certain extent, I believe that. Yeah. You know, I think if you're investing into a business that's creating growth, employment, paying more tax, you know, I'm okay with that. I know there are more specific definitions, and I also like that. It's better to be specific if you want to achieve something. But anyway, let's call it developmental, maybe, because a lot of the mid-large cap deals are direct investments by DFIs or PE firms, and PE firms themselves are majority financed by DFIs, right? And so the sectors are sort of developmental sectors, but the reality is that covers so much. You know, financial services, agri, we already mentioned, healthcare, but also manufacturing, FMCG, et cetera, energy, as long as it's renewable energy. So
and I guess that might pick up because of the UK Kenya trade deal specifically. So maybe more deals in that area.
In renewable energy.
Yeah, renewable energy.
For sure, yeah. So I always, I mean, in a way, it's really nice for us because we can feel confident that we'd be able to close a deal in pretty much any sector. We can find investments in pretty much any sector. Maybe the harder ones are mining, oil and gas, any sort of polluting industries because of this developmental objective. That doesn't really work. But, you know, generally most sectors. And then coming back to your tech point, so for VC, in my understanding, I'm not a total expert, so hopefully I won't embarrass myself too much, but
I'm sure you would.
My understanding is it's pretty closely intertwined with tech.
Yes.
Basically, they're mostly investing into tech or tech-enabled businesses. So that's not just IT or fintech. It's also health tech, ed tech, agri, etc.
Tech-enabled, I think, is a key word in that.
Exactly.
Anything that's tech-enabled, VC is very close to,
Yeah. So it's still... in a way, broadly covers most of the sectors, but it has to have that tech-enabled thing. And so in some ways, you feel a bit sorry, actually, for somebody who's setting up a traditional business. That's not tech-enabled. You know, like a manufacturing business, for example, which is really essential, but it's harder for them to access earlier stage capital.
Correct.
They have to probably finance it themselves for a while until they can get up into that sort of mainstream capital.
I mean, which a lot of people
or maybe
can't
through banks
do,
if they have
through
security.
Banks perhaps, but even then, the interest rate is prohibitive for them. Okay, I think we've covered a lot of ground. What are you looking? 2023 is coming on the horizon. What are you looking at in 2023 that excites you in terms of the PE industry?
I think for us, I don't want to sound like I'm plugging us. I just want to answer your question
this is your chance
honestly.
To do it, yeah.
I think we've happily done quite a lot of PE exits now. 2 in the last 5 weeks, actually.
Wow, okay.
And now, so I think
in Kenya?
1 in Kenya, 1 in Ethiopia.
Okay.
Yeah. One's been announced, one hasn't.
Okay.
But it should be announced in the next couple of weeks. And so that's been a big strategy of mine, actually, for a long time, is to position ourselves to be the leader for exits. Because that's one of the biggest issues for the PE
And are you
funds
tracking like every entry and then exit? I mean,
exactly,
that's smart.
Yeah, we've done it in quite
really
a systematic way.
Yeah.
And been close with the PE firms. We work with them a lot for a long time now, and the DFIs. So I'm really excited about that. I think that strategy is really starting to unfold for us, that, if a decent PE firm's doing an exit, there's a pretty good chance they're going to ask us, at the very least, to pitch for it.
I mean, that's really good.
So I'm really excited about that. It's lovely when you see a strategy working. It's about as satisfying as it gets.
Did you identify that very early as a strategy then?
Yes. Well, I don't know what you mean very early.
Like, did you know that was going to be part of your... Because I guess... Only
feels
when
like
you've done
it's been a long time in coming.
Only when you've done it a few times do you know that that's something that, possibly it's an angle.
Yeah, and I mean, we did a big publication a couple of years ago on private equity exits, actually. And we tracked, like you said, exactly that research, because you can see the number of investments that are made. That's, you can get that data, and then we all know roughly what the time
life
is.
cycle is.
They're supposed to be in there for 5 years, then start exiting and have it wound up in 10. So you can work out which one should be coming when. And there was a big lag. And then I thought it was all going to take off about 2 or 3 years ago. And then we had COVID. And actually what happened was, I think quite a few of the investors got approval from their LPs and underlying investors to wait. Because it's a bad time to exit.
Correct, yeah.
So you had to wait another 2 years for the strategy to come good.
Yeah.
So that's why this year and into next year, it's felt like a good year for that.
Wow.
Anyway, that's a bit boring because that's just focused on us,
that is really cool, because even from an advisory perspective, you can
that's true. That's true.
What can I do? Or where can I position myself? Which is excellent.
Yeah, exactly.
Is COVID forgotten now? Are we not talking about it? Is it something in the past? Do we even need to think about it in 2023 now?
I think in some businesses you can still see it in the numbers.
Okay.
In Kenya, in some ways, we were relatively lucky. That's probably a terrible way to describe it. There was no luck involved. It was a horrible, tragic time.
Yeah, but there was something.
I think,
there was
compared
something
to
that
other
we
countries,
didn't get.
Even in East Africa, like Uganda, where we do a lot of deals, they had much stricter lockdowns. So that's what I mean by that comment. Which hit business much harder. Yeah. And so you can still see that in the numbers. The numbers are still, starting to recover.
Yeah.
Whereas most Kenyan businesses that we see, they manage to find a way to get through it.
Yeah.
With certain exceptions like hospitality, air travel, where it's just a total disaster and there's nothing they could really have done.
Are those recoverable or not?
Yeah, definitely. I mean, tourism, hospitality is coming back in a big way. It's really exciting, actually. Mm-hmm. For Kenya and East Africa, another one for TZ, I think.
Yeah.
So maybe coming back to your predictions, I think we'll see a lot more hospitality deals next year.
Okay, cool.
I think, and we don't have an election to worry about. I think on the negative side, I think, all of this global inflation and recession. Yeah. We haven't seen so much of that flowing through here yet. Yeah. We'll see whether there's a big impact. I mean, I fear there will be at the sort of, unfortunately, at the poor old everyday person level. Yeah. Somehow in this place, they always seem to bear the worst brunt of it.
Yeah.
But then, hopefully all of our developmental and impact partners, that's what they're looking to help with. I think at a business level, we're also we're fortunate in a way that it is developmental capital. And so if it's purely commercial and you're expecting recession, inflation, you just pull out tomorrow, right? Whereas developmental, they don't do that. It's much more sticky than that. So I think deals will continue to be done. And then also we have this massive demographic support in Africa, right? With whatever it is, we'll have half the world's population here in 2100. That means international businesses can't not be here.
Yeah.
Right? And so, 1 or 2 years economic blip is nothing really as part of the bigger picture.
Correct.
So I think we've also noticed in our publications that M&A is starting to come back and pick up. And so, for that reason, I think we'll probably see more M&A as well.
All right.
And interestingly, maybe more real estate deals,
Really?
which we haven't seen much of for the last 4 years. We're also seeing a pickup in fundraising for real estate funds into Africa. So I feel like it's a good year. That felt like quite a positive summary to me.
That's a lot of positives. Yeah, thank you so much, Ed. And really, thank you so much for being here. I think it's been really insightful.
Yeah.
And you've talked about a lot of things that a lot of people will understand and know about already, but in a different context. So thank you so much for spending the time with us. We just have quick fire round questions just to get to know you a bit better. Pizza toppings.
What about them?
Favorite pizza toppings?
Pepperoni, chili, and avocado.
Together?
Yeah.
That's
quite a weird one.
Cocktail? No cocktail? Wine, maybe?
Martini. I love martini.
Shaken, not stirred.
I quite like either, actually.
Yeah. Okay. Wine?
What's my favorite wine? French wine.
Bordeaux.
Can I give a plug to somebody?
Of course.
Yeah, so
someone here?
Yeah.
Of course.
Le Decanter, run by my friend Julie Smith.
Oh, good. We'll put that
ABC.
in the. We'll put it in the. Oh, the shop, right?
Yeah, they have amazing French wine.
Oh, nice. All right, great. I'll look into that.
Yeah.
Favorite holiday destination?
Kalifi.
Okay.
Yeah.
Favorite one of your children?
No way. That doesn't exist.
That's a trick question.
Whoever asked that didn't have kids.
That's a trick question. I'm just joking. Thank you so much, Ed, for being here and spending time with us. And it's been a great interview. And thank you for making the time. I really appreciate it.
Thanks a lot, Joe.
All right. See you guys next month. Bye.